No-code SaaS builder by day, disciplined investor by night. That's my $5 million game plan. In this video, I'm starting both journeys from $0, setting up my bubble-powered software business while independently building my investment portfolio. They won't share funds or rely on each other, just two parallel paths to financial freedom. Want to follow this unconventional approach? Here's exactly how I plan on doing it. The SaaS business needs to generate $17,000 monthly profit within 3 years. While investments compound at 10% annual returns, compound interest does most of the heavy lifting after year 2. But getting the initial revenue stream right determines everything. Most side hustles fail here because they don't plan for scalability from day one. This model works differently through 3 phases. First, validation, proving people will pay before writing code. Next, automation, removing yourself from daily operations. Finally, reinvestment, funneling profits into index funds and dividend stocks. One founder used this exact approach to hit $1 million annual recurring revenue in 18 months, building a no-code scheduling tool. Their secret? Starting with manual fulfillment, using Airtable before automating with Bubble, proving demand covered the tech costs. Keeping business revenue and investment accounts separate creates stability. If the SaaS hits turbulence, the portfolio keeps growing. Conversely, market downturns won't tank operating capital. The separation forces disciplined profit-taking from the business rather than endless reinvestment in features nobody wants. To hit $5 million in 7 years, here's the monthly target progression. Year 1 requires $3,000 profit from SaaS plus $500 invested. By year 3, that jumps to $12,000 monthly profit with $3,000 going to investments. Those numbers sound steep until you see how they compound. Just $500 per month at 10% grows to $53,000 in 7 years. Scale the business contribution proportionally and the math seems to work. The key is starting with SaaS concept that passes real validation, not just surveys where people say they pay. One failed Reddit post almost made me abandon this whole project until I tried direct outreach through LinkedIn, cold emails, that sort of thing. To 80 potential customers revealed there was a few willing to actually prepay for early access. That's when I knew this SaaS product could work. Here's the precise content that allowed me to turn this into a real idea. The turning point came from when 3 CFOs agreed to prepay for a risk management tool that didn't exist yet in the market. Before committing to build, I ran 3 validation methods. LinkedIn outreach with sort of screenshots, a Typeform survey that initially failed, and cold emails offering prototype access. The survey showed 0 interest until I realized I'd targeted the wrong job titles. Switching from risk analysts to financial controllers revealed the real pain point. In fact, multinationals lacked a unified system for tracking operational, compliance, and financial risks. Reddit became an unexpected goldmine, in fact, because a detailed post in one of the subreddits called Finance explained the concept, attracted loads of comments, but 8 users sort of asked for early access. That's when I shifted to direct outreach. 80 cold emails later, 17 prospects booked demo calls, 5 committed to annual contracts if the tool delivered specific features. Real-time scoring, mitigation templates, and executive dashboards. The MVP will centralize risk management for global businesses. Think compliance breaches, supply chain disruptions, and financial exposures. With customizable mitigation plans, I think this MVP will certainly make shockwaves in the market. Bubble handles this app logic for dynamic risk scoring and workflows, which works really well, while Webflow builds the marketing side with SEO optimized case studies. Airtable serves as the database backend, structured with separate bases for risk categories, mitigation steps, and user permissions. This stack outperforms all-in-one platforms on scalability. Bubble's visual programming allows complex logic like conditional risk alerts without code. Webflow's CMS auto-generates client-specific landing pages. Airtable scripting block automates report generation, critical for enterprise clients needing audit trails. Together, they cost 60% less than enterprise SaaS builders like OutSystems while offering deeper customization. The biggest lesson in this, validation requires talking to buyers, not just users. Junior analysts loved the idea but couldn't approve budgets. Directors cared about reducing audit costs, not flashy features. That shaped the MVP roadmap, prioritizing compliance documentation over AI predictions, because that's what's unlocked checkbooks. Now comes the tricky part. pricing a tool that could save companies 6 figures in legal fines. Most no-code founders undervalue their products. They set prices based on competitor benchmarks rather than the actual value delivered. My initial pricing model made this mistake. A simple, $50, $100, $200 structure inspired by similar SaaS tools, but that would not result in many conversions. Conversion rate tests showed enterprise buyers dismissed it as too cheap to be credible, while solopreneurs still found even the basic tier expensive. The psychology behind effective SaaS pricing ties directly to perceived outcomes. For my risk management tool, I map each tier to specific cost-saving metrics. The $100 per month starter plan saves teams 10 hours monthly on compliance tracking. The $349 professional tier prevents, on average, $15,000 in annual regulatory fines, and the $900 package Enterprise Edition mitigates 6-figure supply chain risks. Framing prices against these concrete outcomes increased conversions by almost 40% in early testing. Finding the pricing sweet spot required surveying 2 groups: my waitlist subscribers and existing customers of competing tools. The breakthrough came when I discovered buyers allocated risk management budgets separately from general software spend. CFOs expected to pay $500 plus per month, but needed return on investment justifications. This led to the current 3-tier system: starter pack, professional pack, and enterprise subscription pack. Each tier's features directly address budget thresholds at different company sizes. The staircase approach locks in long-term revenue. All plans include mandatory quarterly business reviews. These become upgrade opportunities when we identify unmet needs. For example, a starter pack dealing with new export controls might need professional compliance templates, so annual contracts get discounts, and that allows us to upsell for the greater or the higher subscriptions. Cash flow timing determined the annual monthly split, so monthly payments fund operations initially while annual prepayments get reinvested. The current mix targets 60% monthly and 40% annual subscriptions, enough predictability for investment planning without stifling growth. Enterprise clients get custom billing cycles matching their fiscal years, which often means larger Q4 deals. But now that we know how revenue enters the system, let's examine where it gets deployed. The investing strategy turns these sort of recurring payments from the SaaS business into compounding assets, but requiring completely different rules than SaaS growth. That $500 monthly investment from SaaS profits grows faster than you'd expect. Here's why. Compounding works harder when you combine steady contributions with strategic asset allocation. My core portfolio uses 3 funds: SPY for S&P 500 exposure, QQQ for tech growth, and GLDM for gold, with dividends automatically reinvested. This mix delivers roughly around 8 to 12% annual returns historically, while minimizing volatility. Index funds win for founders because I believe they require zero maintenance. Stock picking demands research time, which is better spent on your business. The 60-30-10 split balances growth and stability: 60% in SPY for broad market gains, 30% in QQQ to capitalize on AI and tech trends, and 10% in GLDM as an inflation hedge. Crypto gets separate treatment. Only 5% of total investments go into Bitcoin and Ethereum, funded from quarterly bonus profits when SaaS revenue exceeds targets. I believe that's a good strategy to ensure we remain stable and we don't put more money into the higher risk investments. Reinvesting creates wealth flywheel. Every $500 invested monthly at 10% becomes up to $104,000 in compounding in 10 years. But here's the accelerator. As SaaS profits grow, investment amounts scale proportionally. Year 1 starts at $500 per month. By year 3, hitting $3,000 per month, investments compound to $590,000 in 7 years. The key is consistency. Market dips get averaged out through dollar cost averaging as we are investing every month. Risk management mirrors the SaaS strategy: methodical and metrics driven. Core holdings: 90% of portfolios stay in index funds for steady growth. The remaining 10% tests higher risk opportunities, such as AI startups via ETFs, cryptos during bear markets, and sector-specific plays. This venture bucket gets rebalanced quarterly. Any gains beyond 20% get rolled back into core funds to lock in the profits. Projections show $5 million is achievable in 7 to 9 years. A lot of you will think that is not attainable and it's difficult to do, but with the right strategy and consistency, this is definitely attainable. Assuming 10% annual returns and increasing monthly investments from $500 up to $8,000 as a SaaS business scales, compounding does the heavy lifting after year 4. The first $1 million takes the longest, as most of you will know, roughly 4 to 5 years, but the next $4 million will come a lot faster due to the exponential factors involved with the investments and the growth of the SaaS business. Gold and crypto serve specific roles as well in this, that gold stabilizes the portfolio during market shocks. It outperforms stocks in 40% of recession years. Crypto acts as a high-risk growth booster, but never exceeds 5% allocation. The majority stays in low-cost ETFs, predictable compounding. This system works because it's boring, no day trading, no chasing hot stocks, just automated investments fueled by the profits of the business. The difference between no-code dreamers and doers comes down to weekly execution. While others debate tech stacks, winnership, imperfect MVPs, and iterate. That's how you win. Next episode, you'll see my investment plan detailed breakdown. I'd like you guys to comment down below for your $5 million strategy below if you want to jump on this bandwagon with me. Are you focusing on SaaS, real estate, or crypto, or any other forms of investment? I'd like to know. Compare notes with other builders in the replies in the comments if anyone else is interested in those discussions. The most actionable plan I'll look to get featured in the next video with a breakdown of its strengths and risks so we can critique and understand how we're going to grow together. And I'd like to build a community around it. Hit subscribe for real-time updates. Let's build wealth together. I look forward to catching you guys on the next video.